So, my name is David Siddons, and I'm president of the David Siddons Group, and this is our first podcast. This is an unnamed podcast because we haven't come up with a name yet. We're working on that. I'm sitting here with a good friend of mine, Andrew Loranger. Drew is a mortgage broker here in Miami. Drew,
Yes,
welcome to our
Thank
very
you.
first podcast.
I appreciate it.
So first of all, I'm going to ask you to introduce yourself, what you do, how long you've been doing it, what space you work in, and then we're kind of going to get into it.
Absolutely, man. Well, first of all, thank you so much for having me here. This is actually very exciting. And we're here in your office in Coral Gables.
Yes, yeah,
So-
we are. This is where the magic happens.
This is a beautiful, beautiful space. My name is Drew Loranger. I have been doing mortgages in Miami here for about 6.5 years. I work for a brokerage, Miami's best brokerage, in my opinion, of course, as a minority partner called Millenium Mortgage. And so our home office is based out of Davie, Florida. We specialize all throughout Miami, Broward, and the Brickell area. And yeah, man, I'm just excited to be here.
This is cool. So we met in a rather unusual circumstance and became friends. And as we start talking, we're both what we would call eternal students. And the whole reason of doing this is to educate the markets and educate, in the process, explore the conversation, which really needs to be had right now. And this became the first podcast because we're in the month of May in 2022. And we've just seen rates get hiked. And it's creating a lot of waves in the real estate market.
It is.
I think what I'd like to do is I'd like you to start with what happened in the last 5 years. Like, let's take us back to 2017, and then obviously we went through, and then we had an incredible run, like crazy run from 20 to 22, with rates being really, really low. Where were we and where are we now, Drew?
Yeah, so I think, it really started a little bit before that. If we looked at the beginning of the decade, rates were in the low to mid threes. It wasn't until after the presidential election in, 2016?
About that.
And so we started seeing the rates rise. They slightly rose. It wasn't by much. It was about 3.625 all the way up to, in some cases for investors, it was as high as the fives, depending on if, the occupancy type. So if it was an investor occupant, they were getting hit on the rates much like they are now. Now, the difference is in today's climate, it's obviously significantly higher. Investors are getting hit. The rate sheet hits are hard for investor occupants, and primary residences there in the mid fives right now. And so we've seen really in the last 5 years, it was kind of stagnant until COVID. We saw a slight drop. And now that the world's back in business after they were printing all of this money in an effort to kind of combat inflation, and because of some of the issues with supply chain, we're seeing rates rise again. And I mean, this is something that has happened through history. And so it's not a surprise that they're using this as a methodology to fight the inflation. But nonetheless, at the end of the day, it's the consumer that gets hit.
Yeah, and they're getting hit right now, and I think they're starting to feel it because it's been this really great run, and rates have been really low, and people have enjoyed and been obviously driving to buy real estate. And we can see the Fed trying to put the brakes on things. Yeah. Right now, exactly what is the rate level today as of, like, what are we now? 1st of June, literally? Yeah, 1st of June. Okay.
So the 1st of June. So where I'm seeing rates are for primary residents, single family homes, they're in the low to mid fives. When you start going into condos, which most of our market is here in Miami, they get a hit on the rate sheet. It could be as high as a half point. So now we're talking, the higher levels of the fives, sometimes creeping into even, 5.99 to 6. So that's where we're seeing, like, from today's perspective. And this is, again, for, your typical borrower that has over a 700 FICO. If you have under a 720 in this market, or even a 700, you're really getting hit hard. The rate sheets, they're not favorable to those that have less than a 700 FICO. Is what we're seeing. Now, a lot of our deals are in the non-QM space because Miami is Miami. So a lot of these borrowers either don't have tax returns, they don't, they write everything off, or they're buying non-warrantable condos, condo hotels. They've got some peculiar situation that doesn't fit in line with how the rest of the world operates, or at least the United States. And so we end up seeing a lot of them are in the sevens right now. Whereas 6 weeks ago, these were in the high fours.
So I deal with a lot of high-level real estate, the high-end real estate, the luxury, the prime and the ultra-prime. And those guys, obviously, single family, they've got great scores. They've got really a lot of liquidity. Yeah. right now, if they're going to be paying around 5.5%, and it could be a little bit higher, close to 6%, where do you think it's going to go? I mean, where do you see it going in the next 12 months?
If I had to guess, and again, I don't have a crystal ball. If I did, it would be great, obviously. But, from what I've seen and kind of looking at some of the charts, I would assume that the rates aren't going to come down for a while.
Yeah.
I would assume that they're going to go up a little bit this year. The Fed's already talked about having another 2 rate hikes at minimum. However, I think in preparation for that, the rate sheets are kind of baked in right now. They've baked in some of that expectancy. So I think we'll probably see a slight rise. I would assume we'll be in the 6s, maybe even as high as the 7s by the end of the year. But I think we've seen such a dramatic increase in such a short period of time that it should taper off, in my opinion, and I think level out. That's what I would assume would happen. However, again, it is quite possible that we could be in the 6s, even as high as the 7s by the end of the year.
When they brought out the last hike, and as things are happening now, were you surprised by that, being in the industry? Was it something that took you back? Did you think they did it right? Do you think the Fed's got it right? Do you think they're getting it right?
That's a really good question. I didn't see it happening this quickly at all. I didn't see it. It's different because, again, I do a lot of non-QM stuff, again, with wealthy buyers, jumbo, super jumbo. And a lot of these clients, they were already in a space that is traditionally seen as having higher interest rates than your traditional conventional loan because it's typically a private bank that's financing these things. Where I saw the massive hit wasn't necessarily on conventional side, although, when you're looking at it, it is a dramatic increase. The non-QM side got hit bad. I mean, within 6 weeks to see rates go up.
What is a non-QM? Just to be clear, what a non-QM side is.
So basically, if it does not fit into Fannie or Freddie Mae guidelines, it is a non-QM loan. So conventional loan limits, they're $640 for the county, roughly. And so if you go above that, you're in the jumbo space. Now, a lot of conventional lenders are doing jumbo loans, but what happens when you don't qualify because you don't, you're writing everything off on your business, you're self-employed, you're not a W-2 borrower. And most of our very wealthy clients are not W-2 employees. These are business owners. These are people that have very successful corporations, a lot of employees, a lot of write-offs. So traditionally, these people do not qualify with a conventional loan. A conventional loan is a QM product or a qualified mortgage. A non-conventional, typical loan is a non-qualified mortgage. It's something that typically only our private banks are offering. Now, most borrowers come to people like myself who are brokers because we have access to all of these lenders with these, hundreds of varying products that they can't get at Wells Fargo or Chase or Bank of America or even by their wealth management team. So, we saw a dramatic increase in rates on the non-QM side. But again, we've seen, a significant hike. What I have seen occur, to answer your question, where I think the Fed did get it right in a sense because they're really trying to combat inflation. And they're trying to taper back, the borrower's ability to get financing because they want to kind of reduce the demand, right? The problem, however, is what I saw a real impact in was people who were purchasing as a primary residence. People who are purchasing as a primary, although they're not getting hit as hard on the rate as investors, they are deterred from purchasing in this market right now because their payments have risen dramatically. Their buying power is reduced, especially if they're in the $250,000 to $650,000 or $700,000 range. I know that that's not your or my typical clientele, but those people got hit hard, and it's like really the lower and middle class that I saw impacted.
What seems to be one of the big things that I look at with interest rates, and I think it's really important to understand, is that when you're weighing up where markets are moving, the psychology of the masses can affect the few. So it might not be relevant to you, but what ultimately we see, and it's come down the media pipeline already, is a lot of negative press, if you want to call it that, a lot of less than bullish dialogue about where our market is where it's going. And there's two sides to the coin, and we're seeing both sides of the conversation. I'm seeing on one side people saying, no, it's great. We have a shortage of houses. We have a high level of demand. We need to satisfy mass migration, specific to Miami, people coming in.
Yeah.
And then the other side, you've got this crazy run where we've seen like 27% increase in the value of homes last year. And I think the year before was probably very, very similar. So now you've got owners who are looking at properties and seeing the values of their home go up exponentially. Yeah. And then the buyers looking at those and saying, oh my God, like it's 50% more than it was 2 years ago. and they have a need to buy, but when things move, they just seem to me right now, be looking at properties and saying, you know what, I just don't think I want to go over asking price. I don't want to be 10% over asking. I don't want to be 5% over asking. I don't want to get into crazy bidding wars.
Absolutely.
The realities that we see come from the changing rates is that group psychology which gets affected. So when people are calling you and they're coming to you, in terms of the activity, and again, let's look at the luxury end, have you seen the number of mortgage applications at the high end of the market start to soften, or is it just business as usual?
I mean, to be quite honest, it's business as usual. Where I have seen a reduction is, again, in the primary residence, single family home, buyers under 700,000. I have seen a dramatic reduction in those applications come in. I'm also in a very different scenario than most loan officers here in the city. I would say 80% of my buyers come to me under contract already. So I have a different situation than I would imagine most loan officers here, because they're pre-approving someone and then they're going and shopping, then they find a place, they go under contract, then they get the deal, right? Yeah. I would say the majority of my business already comes to me under contract. And what's crazy is, especially in this market, I would say 7 out of 10 of my contracts come to me as cash contracts. And they're waiving contingencies on everything, waiving appraisal, waiving inspection, they're waiving finance contingency, everything. These are cash contracts. And I have had to close people that did not qualify in hard money loans because, 12-month bridge loans, because they did not qualify and they didn't even care to go get qualified before putting something under contract. And I've seen that more and more now than I've ever seen it before, which is insane to me.
It's wild. It's good you raised this now. I was going to raise this question later on, but you've raised it now, so I think let's get into this. The behavior of buyers coming in and the amount of pressure, because if I look at my numbers and I look at my charts,
sure,
our inventory is still very, very low. And I think there's a lot of pressure on buyers who say, you know what, if I want to be in a running chance of getting this property, I've got to get in my offer right now.
Yeah.
And I got to a stage where I was seeing buyers would call me and say, you know what, I want to buy that house, but I want to make it subject to finance and subject to appraisal. I'm like, you might as well not even bother. Just don't even bother writing the offer, because you've got more chance of tying your arms behind your back and beating Mike Tyson.
And most of the sellers agents, they know that this property is not going to appraise.
They know. Most of them are cash, and they know, they're aware, because the banks are still playing catch up as well. And that segues into, I guess, another question, which is the appraisals and how they're handling things. And are they behind this? Are they in front of this? Are they getting it all wrong? I mean, this is probably a pretty contentious issue for a lot of buyers and sellers.
Oh, for sure. Man, I have had more issues with appraisals than you could imagine. I'm sure you
give me a story. Give me an example.
Man. Okay, so I just had a unit last month at the W, Tower 3 of the Icon Brickell. The appraisal, what was the purchase? I think the purchase price was $850 and the appraisal came $250,000 short, which is insane.
Especially more than 20%.
Yeah. 25%. So, I mean, the buyer ended up, this guy waived his appraisal contingency and his finance contingency. So he brought the money to close. Yeah. If he had not been able to do that, we would have had to come up with some other type of scenario. I mean, we try not to, I never just reject a deal, especially if they're under contract. Their earnest money deposit is my money, basically. Like, I'm trying to protect it at all cost. And also I want my agents to get paid and I just want the deal to go through. So we really will fight to make a deal happen. But it has been very difficult where this is not the first scenario. I mean, this was the more dramatic one, especially based on that purchase price. To see something come in $250,000 short is insanity. But it's not always that dramatic. Sometimes it's 50,000, sometimes it's 100,000, sometimes it's 70. I would say out of all the deals that I've done in the last 4 months, maybe 3 of them came back with an actual appraisal at or above purchase price. And the reason why this is occurring is because these appraisers base their comparables off of closed sales. Some of them date as far back as a year ago. If you look at the reports, you're using a comp from a year ago as a completely different environment. How can you justify using a comparative analysis on a property that closed, even if it was of similar structure, square footage, room, bed, bath count, etc.? How are you going to use something from a year ago? And that's what a lot of them are doing. So what I've had to do on almost every deal is I've had to go back to my buyer's agent, or now I just prep them.
Didn't you say to me that you threw out, or you contested like 9 out of 10 appraisals that came through, you were fighting them.
Oh, no, 100%. So I prep my buyer's agents in advance, give me comps or have them prepared for the appraiser when they come. And then what I end up having to do is I have to send in revision requests for every single appraisal, send them comps, get into arguments with the appraisal management company. I mean, it could delay the deal by 2 weeks, just the whole process.
Yeah. I've had the same happen with me and my clients. And I have a theory, and I don't know if this theory is true or not, so you can validate it. But my theory was this. The banks have a very clear framework. They're like, we've got to work within these confined spaces. And the confined spaces are like a 20% variance of size of lot, size of house, within a certain geographical area. And because the target's a moving target right now, and the market was moving, if you break it up and say, okay, so market moved up 27% last year. What does that break down per month? It's what, about 2 and a bit % per month? 2.5% every single month. The value's going up. So if you go back 6 months, all of a sudden you're at 15%. You're a 15% difference, and 15% is massive.
I mean, that's what makes up the difference. That's why we're seeing these appraisals come short.
Yeah.
And so, like you said, the banks really operate on a checkbox system, especially a lot of these private lenders, even the conventional lenders. What they're doing when they box these loans together is they put them into a mortgage-backed security of similar products, sizes, loan amounts, credit scores, etc. Put them in a mortgage-backed security and they sell it on a secondary market. So that's why someone, you might close with Chase and then 6 months later you end up with Wells Fargo, and all of a sudden you got a letter in the mail and you're like, I have a new lender. Why? Well, it's because you got sold with a bunch of other loans. So what happens is in their auditing of these on the secondary market, they're going to pull loans at random. And if those loans do not meet that specific criteria and meet the check boxes, they're going to have a big issue. That's when loans can get called back. The lender has to pay back. If it's within 6 months, even the broker has to pay back their commission. And it's just like a mess. So the lenders are following their guidelines and they are trying to meet certain criteria regardless of how, outdated or arbitrary they may seem. This is what they're doing, is they're checking the box. So I just had a situation this morning where I do a deal called a debt service coverage ratio loan. It's like I market it as my Airbnb loan because all of my Airbnb investors use it. So we do not require income documents whatsoever. It's a no income loan basically. And the reason why is because it's qualified almost how a commercial deal is, where the property actually qualifies itself instead of you as the client. So when we send out an appraiser, they not only assess the appraised value of the property, but they also assess what it could rent at on a 12-month long-term lease. Now, as long as that rent or projected is $1 higher than the mortgage, it's 20% down. The rate is whatever we quoted them at the beginning. If it comes under, they have to do 25% down, and they usually get hit like a half point on the rate.
Doesn't that sound like, back, everyone's seen the movie The Big Short.
Yeah.
And everyone goes back to like 2007, 2008, when people were borrowing money that really had no business borrowing money. They couldn't pay it back. Now we're talking about potentially a situation where someone is borrowing money not of how much they can pay back,
correct,
but assuming that the rent is going to cover them. Now, that's fine if the rent does, but if the market shifts and people stop paying that level of rent, doesn't that cause problems?
Oh, 100%. And I think, I talk to my team about it all the time. We believe if there is going to be some type of bubble in this arena, it may truly come from this specific area.
Yeah, because there's a lot of cash still floating around in the system. And again, I'm a big follower of Ray Dalio, his principles. People have known me for years who have been reading my reports. And again, I always lean into the human behavior and I try to understand why people doing what they're doing. What is driving them? What's changing their actions? And when I see investment behavior and investor class behavior, and when I see liquidity, and right now, because again, tying into this, because of our stock market being so frothy and volatile, and people stepping back and saying, what, I'm taking my money out. I took all my money out of the markets. I was like, what, I'm done with this. I don't have the stomach to take these kind of hits.
Yeah.
I'd rather be able to be in a system whereby I can kind of see what's happening. I can read my markets much better. And again, I sell real estate for a living, so it's much easier to do that. But then when you take the money out and it's sitting in the bank and then you're looking at inflation that's 7% plus, and you start to think to yourself, Christ almighty, if the cost of a loaf of bread or some milk or gas or anything else is going up, then I'm actually losing money right now.
Absolutely.
So I really want to put it to work. And we've seen a lot of people investing and running into the real estate investment space especially with Miami, because there's so much migration here. So many people need homes. Not everybody wants to buy. Not everyone is ready to buy because they're trying to acclimate themselves to a city that they don't really know that well. There's been this new influx of investors trying to buy up product off high rental returns. And that is like the condo space and the Airbnb space. That's really been a big one. The Airbnb space, which is something that we spoke about on the phone. Take me through that. Take me through that whole Airbnb principle. For those who don't know and are watching this, what is driving that right now, and how could this shake up?
Yeah, so I do a lot of these Airbnb deals, a lot. I would say the majority of my deals are well over $1 million, single-family homes with a pool, Coconut Grove, the Gables, Miami Shores. Miami Shores are a little less, but I'm doing nothing but Airbnbs right now. I mean, the W, Fontainebleau, all of these buildings that allow for short-term rentals.
Which ones do allow Airbnb? Because a lot of people ask me, like, and I don't fully know. I have to get into it.
Yeah.
But give me like 5 buildings that let you Airbnb.
Sure. So I've done so there's Brickell Bay Club. I've done the W. There's a couple buildings in Midtown. The Opera is not really doing these short term anymore. They're doing month to month. However, there is kind of a workaround that I can't really get into, but I do have clients that are doing it at the Opera. And then a lot of the condo hotels. So I mentioned the W, but we also have the W on the beach. We've got the Setai, we've got Fontainebleau. I've done most of these condo hotels. They do require a larger down payment. So like, whereas a Fannie Mae approved building, which there are very little of, is only requiring 5% or even sometimes 3% down, these are requiring 30%. I can sometimes get away with doing 25% down, but you got to pay to play with these buildings because the banks see them as a higher risk for exactly what we're discussing. So what I've seen drive this huge Airbnb craze is kind of like the phone a friend mentality, where it's like, I was on the phone with my buddy and he's making $40,000 a month in net profits off of this Airbnb property. How the hell do I do this? And I tell him, you need 20% down. As long as you own a property, I can do this, this debt service coverage ratio loan. We don't even have to look at your income. We can close it in the name of an LLC. We can protect you from any types of, issues. We can limit your liability. You can open up a bank account. You can kind of structure the whole thing like a business, right? Open a bank account for the house. Okay. So your rents are going from Airbnb into the bank account. You're paying your mortgage from the bank account. You can write everything off from there. So it's literally structured as a business. It's very enticing. And so these people, they're like, okay, well, I need 20% down. The majority of them, to be completely frank, can only afford maybe 5 or 10. So they get all their buddies together. They got 6 or 7 buddies. They put it under someone's name, that's on the deal. And they're all just structuring their finances together in order to buy these things. I have seen this more times than you can imagine this month.
So it's a group of young professionals.
I would say if I had to...
And they're all back. Like, I'm trying to imagine the guys who are doing this. I'm just seeing a bunch of crypto kids running around coming up with illusions of grandeur. This is what it is. Really?
Yeah. I mean, there's also a lot of young professionals that are actually making good money, W-2, or they're self-employed. But I would say like 50 to 60% of these Airbnb situations that I do, if not more, can comprise of these types of situations where people are putting a joint venture agreement together. They're all going in on a house. And, they might not even qualify for the DSCR program, so they're going hard money. So
it's like, I don't want to have a proper job. I want to set up my business as Airbnb. Let's run out there and buy and I've seen it in the Grove, like Coconut Grove.
Yeah. The Grove's crazy.
It was nuts. I had a personal experience myself where I was building my own house and I was in a gap between moving into the new home and going out from the old home in about a week to 10 days I needed. So I called a guy that I knew in the Grove and I said, you want to rent your house out to me? And he was like, well, I'm doing Airbnb. And I was like, oh, that's good. And then as we start talking, he bought the house. I think the market value on the house at the time was like $2 million.
Sure.
Maybe when he bought it was 2. And then it's worth like probably about 2.75 now. I said, how much are you making? And he said to me, David, I'm getting I said, how much are you going to charge me? And he said, well, I'll charge you, I'll be a little nicer to you. I'll charge you a little bit less than what I'm charging everyone else. And I was like, well, what's that? And he said, $13,000 for the week. I'm like, 13 grand for the week? So how much are you making a month?
No, that's what it is.
And he said it was booked, like after
months in advance.
You book months in advance. So I look at this, and this to me this starts to drive the home prices up, because then you've got other people in the area who are wanting to buy homes as a primary residence. And of course, these houses, not only are they making the money on the Airbnb, but the value of the home went up.
Oh, dramatically.
So you're making like 40 grand a month on your $2 million asset.
Yep.
And then it went from 2 million to 3 million. I mean, it's just kind of crazy.
And your payment is on something like that between, well, now with the rates, but you're talking like 8 to 12, 13,000 a month, right? Sometimes 14, depending on the area, flood zones, et cetera, right? But it's like, you know, the net profits on these things are insane. And so that's what I see driving it, is like, everybody's got a friend that's making all this money on an Airbnb, and they all want to be in on it. A lot of them can't get in on their own, so they're getting all their buddies together. These people, in my opinion, are so short-sighted, just driven by the profits of the short term, which is fine, absolutely. And this is how I've made a lot of money off of this type of business. So I don't I'm not saying that I don't condone it.
I don't want to take the business, I'll take it.
I'll take it, But what I'm seeing is the short-sightedness of the fact that a lot of these people are jumping into hard money loans because they do not qualify in one way or another. They're getting, let's call it 9%, 8% interest rates on a 12-month bridge, at which point, at the end of the term, it's all due in full. But we don't know.
So they could get spanked if it doesn't work out, doesn't play out the way it should.
We don't know where the market's going to be in 12 months.
Yeah.
And so it's like, all right, I'll pay 8%. I don't care, because I'm making still $25,000 a month off of this property. It doesn't matter. Right. And so I'm hoping, and what I advise most of my clients is, with this whole, creating a bank account, an LLC, et cetera, stash that money away. But I'm not seeing that. What I'm seeing is they're stashing all the cash and then using it on another investment property. And they're doing this over and over and over again. My average Airbnb buyer buys at minimum 1 to 2 properties a month using me for financing.
So you might want to think about it. Those people who are buying homes in other areas and they're buying it for themselves, if you are finding there's a very high density of Airbnbs around you, you might want to be a little bit wary of how things could shake up. Because back in 2008, and not many, there's a lot of people out there making money who were at school or college.
Sure.
And they were living off, ramen noodles and concentrate juice.
And credit cards.
And credit cards. When this all shook out in 2008. And that's when I stepped into the business. That's when I came into the business. So I saw the real effects of an economic downturn. And I saw people lose their properties and then get repossessed. And the psychology then at that time, before it all shook out, was, I'm going to get in, I'm going to buy property, I'm going to go up in value, and then I'm going to get rid of it. I'm going to be out of this before the whole Ponzi scheme house of cards collapse. And right now it's the same thing. It's like, get in it, and it might work out for some people, but you've got to time it.
You have to time it.
And it's Russian roulette.
Yeah, but they're not, most of these guys are not timing it. And the ladies, I use guys, but they're not timing it, man. They're getting into it. They see the profits. They think it's never going to end. And my fear is, and without being too speculative or putting my opinion in it, what I would, I guess, like to generalize and bring to the surface is this concept of thinking a little deeper about what happens if there is an economic downturn. How many people are going to be renting? How many people can afford to go to Miami and spend anywhere from $1,000 to $2,000 a night on a house?
Yep.
So if my business just took a downturn and I had to let go, this is a perfect example. I have a guy right now. He owns a title company. He specifically only worked with mortgage companies who did refinances. Well, that business is damn near gone. So if all the refinance guys at houses, they never shifted into the purchase game or into the cash out game, and they just did rate and term refinances, they're dried up and gone. So my buddy, he's had to let go of 50% of his staff in the last 5 weeks roughly. And so he's telling me, I used to go to LA at least a week out of the month, and I would rent this incredible spot. I would Airbnb for like $4 or $5 grand a night, because he had it like that. And he was like, now I'm not renting that. He was like, I don't even know what's going to happen in the next 12 months. So this is just one individual's mentality of what might happen. Now, when it actually does happen, or if it actually does happen, how many people are going to pull back and say, I can't go to Miami with my girls this weekend for the bachelorette party. We can't buy this house.
Yeah.
Because there's been a slowdown, or I just got let go. And so that brings back, I'd love to hear your insight on like what you saw in 2008. and the impact that had, because if it plays out similarly, you're going to have a lot of people that are in these properties with debt obligations of anywhere from $8,000 to $20,000 a month that are now sitting on monthly liabilities, not assets.
Yeah, I mean, I think as things play out, there's a few sayings like rising water raises all boats. Sure. We've seen a lot of people make money, a lot of money in the last couple of years, and whether it was in the real estate space or the crypto space or the stock market, they get the assumptions that things are just going to keep going the way they're going. Well, there's a wake up, and it's coming, which is that trees don't grow to the sky. My dad taught me that, and still tells me today. Don't assume that things are going to keep moving up the way that they were before. Things can stabilize, and the question now is crash, correction, or continued growth.
Yeah.
And I see that in 2008, when things were really, really bad, people pulled back, people were trying to hang on, and then they just lost it.
Yeah.
And there was correction. Now, we recovered really fast. Miami recovered astronomically quickly. I think about 18 months to absorb inventory. What I think that we have right now, and this confuses people a lot in the real estate space, is that you've got different dynamics at play. You've got things that will make the market contract, and obviously interest rates and shaky psychology. But then you've got other things such as migration, which drives people in.
Exactly.
And legitimate business growth. And we try to look at that really, really closely. And recognizing there's still also a lot of liquidity in the system. That's one of the things that seems to act as this counter-argument when people say, look, I don't see a correction coming because there's just way too much money in the system to create it. Well, yes, it won't happen the same way as it did last time. And the whole sector, the whole market just doesn't do the same thing. There's those conversations that we have which don't have a general conversation about the real estate market in Miami because it doesn't make any sense. It has no place. You have to get very specific. And if you are going to look at a particular corner, and this is why we have, in the David Siddons group, we have territory managers who live and work in those areas. They understand the demographics within different areas of the market. So if there are pockets which are heavily investment-based, you've got pockets that are very primary. There is a robustness and there's a fragility to different price points within our market. And from what I'm gathering from this conversation, at the lower end of the spectrum, where we saw houses go from 400 to 600, 800 very, very quickly, for that group, the sub 1 million, they're a lot more reliant on mortgages and mortgage payments and keeping up with paying. And they don't have as much disposable income, as much disposable cash to ride through a difficult time. That, if that gets out of control, they're going to be forced to have to rethink their lifestyle, and that could mean selling their home. And then you kind of shift downwards. Once we get into the high level, I mean, the 3 to 5 range, we don't have a lot of inventory, and there's still buyers coming in.
And most of them are cash.
And they are cash. A lot of them are cash. Although I think the thing to remember is that if you're a cash buyer, you're still probably going to be chasing a mortgage because rates were so low. And at the time, I did see buyers in the last year who said, I don't mind overpaying a little bit on that house, paying 5% above ask or whatever it might be, because my rates are so low. I look at my monthly payment; it's still absorbable. It's still good. I'm kind of robbing from Peter to pay Paul, but I'm okay with that. Now that kind of free gift is gone, and now it's more like, okay, now the rates are going to be up a little bit. And if the market's getting retraction, because that's what the Feds are trying to do, trying to pull us back into more normal behavior, those buyers are going to say, I'm not so willing to overpay now. So the 27%, 30% increase in value of homes, I just don't see that this year. I think no one does. No one I know in the high-end real estate space believes we're going to see these sudden explosions of value. I think we can see a return to norm. Supply and demand is still the underlying rule of thumb for any system, any economic system. And you can't get away from that.
That's a driving factor here. It's huge. I mean, I was at an open house 2 Saturdays ago. Where were we? It was South Miami. No, it was Homestead. And I don't venture to Homestead too often, but I've noticed.
I ride down there and then I come right back again.
Exactly. And I've noticed a lot of people are going to I just got 3 contracts last week from Homestead. And I'm like, I've literally never done a deal in Homestead in the last 6 years. And now all of a sudden I got 3 contracts in a week. This is very bizarre.
Why do you think Homestead, I mean, I've got a theory, but I want to hear yours first.
Yeah. So I think it's because the home, you can get so much for your dollar down in Homestead. It's kind of like buying outside of Miami, buying in I'm from Virginia. You're basically getting what you get in Virginia. You get like an acre or two of land and a house 3 for like 500,000.
Really? Should I sell my house in Ponce Davis and move to an acre for 300,000?
I mean, look,
it'll cost you $4.5 million in Ponce Davis.
Yeah. So this is So look, I just do the lending. I'm not the real estate expert here, so I don't know like square footages and all the prices for these things. But I can tell you that this specific property that I did the open house for, I believe it was a 3-3, and it was sitting on I think it was a half acre, and it was a half acre, and it was $440. There was a line 3 blocks long down this place. It was in the middle of, like, our opinion, nowhere, right? It was in the middle of nowhere. There's blocks and blocks. We had over 50 people come. And on the spot, there were 15 offers over ask.
Does it strike you as like a little weird, like when you get there and you go, this is insane?
I was like,
it doesn't feel normal.
Other day of the week, that's not the day of the open house, this place is probably a ghost town. There's dozens and dozens of vehicles. It was crazy. And I'm like, you couldn't even find a place to park on this tiny ass little neighborhood.
I've seen that. I've seen that in this area in January, February, and March. And I remember running an open house where literally it looked like we were running a block party. It was. That's
nuts. What it looks like. Everybody's lining up for a barbecue.
Yeah, and we ran it, and it was full on. And then I think over the last month or not, things calmed down. But what I did see is that on that end of the market that you're talking about, houses got so expensive for so many people in what I call the primary market. So our primary markets are like Pinecrest, Coral Gables, Coconut Grove, South Miami, High Pines. These are the areas where families move to because it's where the best schools are. But the reality is, and then they're going to work in the cores, whether they're working in Coral Gables or in Dadeland area, or whether they're working in Kendall, or wherever they're working.
Sure.
But houses got so high. And sometimes I look at these reports that come out through Realtor.com and Zillow and these other sites, and they talk about the real estate market softening, and they talk about, the median house price. And I look at it and I'm like, this has zero relevance to these areas that I'm talking about, because the median house price that they're promoting or talking about somewhere in the US is, or even within Florida, it's like 450,000, 500,000, which you can't even buy a garage in these areas for that amount of money.
You could buy a parking spot.
Yeah, pretty much. So we give you one parking space and maybe a tandem if you're really lucky. Yeah. And then what happens is these families move here, all this migration that's moving in here, they can't afford these areas. Mm-hmm. So they start to move out of the city and they start to move further afield because they don't really have much choice. And there is obviously, there's the core staff, and within the areas that I work, you've got people, the hedge fund crowd, the private banking sector, the entrepreneurs, all the different, the 1%ers. The reason that people move down, because that 1% tax saving drive are coupled with a bunch of other variables that we'll get into in another conversation. And they come in, and of course, they come in from California and New York, and they have deep pockets, and they're the top 1%. But then there's all these support staff. Like Amazon have a place here, Google have a place here, all these other big companies, organizations have a place down here in South Florida and in Miami and Fort Lauderdale. And they have these staff that can't afford to spend $2 million on a 1,700 square foot house. They simply can't afford to do that. So they then move further south. And I understand what's going on there. And I think that Miami is going to continue to grow. But I think we have to be aware of how fast it has grown and the realities of those who are moving as primary and those who are just coming in to buy as investments.
And I think that's exactly it. So I'm seeing a migration out of Miami into these other sectors, like you said, of Homestead or up north and Northwest Broward. Not as far as Weston's obviously a different story, because there's still high-priced homes there and Southwest ranches. But talking about the outskirts where you're seeing properties that are still around $500,000 or $600,000, I'm seeing a lot of families move out there, even for renters, because the fact of the matter is, because of how the market has shifted and inflation has hit us and the prices have increased and the rates have gone up, people from Miami generally cannot afford to live in Miami anymore, because our median income, I would imagine here, it has to be like 40, 50K, and what are you going to do with that? I mean, you can't even get a 1-1 in downtown or Brickell for less than 3,500.
Well, you mentioned something else that just came into my head, which is the whole refi situation. And one of the big problems that we've got right now, one of the big standoffs that we've got, and we've had it for, I think, the beginning of the year, that we would go and knock on doors all the time. And we do, because we're farming, we're asking people who want to sell. And the same answer would come back, which is, you can offer me whatever you like, but where am I going to go? What am I going to buy next? And if they do buy right now, if they do sell and they do buy, and I had this conversation with a client this morning. He said, you know what, I got a really good rate for my condo. Mm-hmm. And now I'm being offered, like an agent called me and said, you know what, we'll give your guy $1 million net, you know, without commissions, without all the other closing costs, like $1 million in his pocket, more than what he was in it for, which is somewhere around 60%, 50% of what he originally paid. And he said, you know what, it's very enticing, but I'm at a zero-sum game. If I then go out and try and buy something else, I'm probably going to have a hard time finding it. And then if I do find it, two things are going to happen. One, my property taxes are going to go up, so that's going to whack me. And two, my financing interest rates are going to go up, and that's going to be a second smack.
Absolutely.
And then, so why would it make sense for me to sell? So now we have this standoff that's going on, and so obviously one of the things that we're trying to do is we're trying to find a solution for those clients, and we're starting to see people who are close to the age of retirement who don't need to stay in Miami. They're moving way out. They're like moving. I've seen we've seen areas like Vero Beach and Pompano and other areas that you wouldn't have thought of, like much, much further up into Indian River County, areas that people will now look at to stay in South Florida because they like the lifestyle down here, but they just can't afford to stay in Miami-Dade or Broward to the same quality of life that they had. And it happens through the entire level. We're not talking about $1 million properties here. I'm talking about clients who will say, I have $5 million and there's nothing for me. There's nothing for me that I like in the area. So if anything, the question now might be, because the Feds are trying to control the growth, that maybe will the lowering interest rates open up? And this is something that people ask me. Will the raised interest rates open up those markets for more sales? Will we see more inventory come in because of that? And what's the back and forth involved?
Sure. And man, you brought up some really good points. And it's hard to answer that, at least with any type of certainty, because to be quite honest, it's a catch-22. Like you said, we've got people who don't want to sell, or maybe they do, but they don't know where they're going to go. Right. And so I had this conversation with my parents recently because I'm like, you guys need to get out of Virginia and, you know, come down here, and you're going to save on property taxes. You're going to save on, you know, because they get billed every month for like everything they own, automobiles, everything. And so I'm like, there's just such a more economical benefit to you coming here. And they're like, so what are we going to do? We're going to sell at a high, but then we're going to have to pay a high and get a high. You know, if we pay cash, we're paying, you know, over ask. And then if we get a mortgage, which they don't really need, you know, we're going to get a crazy rate, and now we're going to have a monthly payment again. So you've got that side of the coin. And then you also have the rising interest making it almost, I don't want to say unaffordable, but less affordable for people who have a budget.
Undigestible maybe is a...
Exactly, undigestible for a monthly payment that just went up. Like on a $4 million house, you know, the payment probably went up $4,000, right? So you've now got these people where they can afford to buy. There's now more inventory, but it's up in the air. It's up in the air whether they want to do it or not. It's going to come down specifically to what these people are willing to pay and if they're willing to take the hit. And so what I've seen is like roughly one out of, and you could probably attest to this, 1 out of every 4 purchases are probably cash, right? And it could be a little higher.
In my sector, it's probably higher. To be honest with you, I think the sector that I deal with, which is really that 2+ range, and again, when I'm personally dealing with levels, it's higher.
It's probably like 3.5 out of.
We did 149 transactions in 2021. It was crazy. It was like one every 2 days, and I do not honestly remember out of those 149 how many. It was so few. How many were reliant on getting a mortgage to let the deal go through? I wouldn't assume, I wouldn't worry about almost any of those 149, whether it was going to close because of finance, because they might have been chasing it, but they didn't need to. They had the cash. But again,
and I don't honestly, I don't think that sector of the market will be as dramatically impacted, because like you've said, the majority of those are cash purchases. They're strong. It's not like 2008 or leading up to that where everybody was getting a loan on everything and most of these people weren't qualified. I mean, we have a very strong market that has an influx of cash and, like you said, a reduced inventory. So I see strength in the Miami market. I see strength from owning it for your personal, or I see strength for owning it as an investor. Now, where, as we've spoken about, I see a bit of a raise for caution is in some of these, Airbnb situations or, some of these rental situations short term, if there were some type of downturn in the market. However, from a standpoint of buying, I think it's still a strong time to buy. I think we're not going to really see a dramatic reduction of buyers coming into our market because everybody wants to be here right now. But what I am seeing is people are going to have to make sacrifices if they are getting a mortgage. They're going to have to make a sacrifice on if they're willing to pay a little bit over ask, how much, if so, because their mortgage payment has gone up. So they've got to have the cash to not only come up with the difference over the purchase price, but they're going to have to 9 out of 10 times in this point in time come to the table with more cash because it didn't appraise.
Yep.
And then they're going to have a higher monthly payment. So if you're getting a mortgage in this environment, be prepared, and you're going to have to make some sacrifices in order to get what you want. But I don't think it's always going to be that way. So
factor in the next 12 months. Factor in where things are going to help you recognize worst case scenario.
Yeah.
And we'll be reporting on this. I mean, this is the one thing that we do. This whole process of doing these podcasts is to educate the market. Absolutely. And educate them early on what's happening so you can stay ahead of the game. Because if you act by the time it gets out into the mainstream media,
it's too late.
You're done. It's way too late.
It's too late.
And then you're just going to be...
Unfortunately, that's where about 99% of the players are at, is they wait till it's in the media, and by then it's too late.
Yeah.
So I think it is very important to look at the next 12 months. Where do we think we're going to be? But also not being as short-sighted. Also thinking about maybe not just the next 12 months, but what's going to happen in the next 12 years. And if you look at it from that perspective as an investor and even as a homeowner in general, even if it's your primary residence, where's the market going to be in 12 years? I mean, look at where it was 5 years ago. Wynwood was practically the hood. Now it's this massive development. We have 52 buildings going up between now and 2024. So Miami is growing. Miami is booming. Miami is not going anywhere anytime soon unless there's some crazy flood or something, water levels. But, Miami is a strong market. People want to be here. Developers see it. Everybody sees it. And I think that it is a strong market to buy. Now, if what I would urge people to consider is if you are going to get a mortgage and you're going to get a higher interest rate, don't just look at the short term, but think about, in a year or two when rates come back down, refinancing. Because the rates are not going to stay like this forever. Historically, if you look at it, rates didn't stay at 18% all through the 80s. They actually reduced significantly by the end of the 80s. So it was a refinance boom at that time. And that's where you see these chop shops and the refi houses all come back into business. And it's like a bonanza for these people because everybody and their mother is refinancing because they could reduce their payment anywhere from $800 to even several thousand on a high end. So I think we're going to see a lot of that in the coming years. I think that's something to look forward to. But I also think, especially for these cash buyers, when there's blood in the streets, that's a time to buy. And if there is any type of correction, I think you're going to see an onslaught of buyers hit the market. And I think we'll see the same thing happen all over again, where there's going to be a reduction in inventory.
Absorption will happen quickly, just like it did in 08. Within 18 months, we went from 100 months of inventory in certain sectors down to like 12. And we looked at this and said, we've got 10 years supply of inventory across this market. How on earth are we going to keep 10 years of supply and bring it down to normal? Well, guess what? It happened, it felt like almost overnight. In 08, it was disaster. 2010, 2011, it just got absorbed.
Yeah.
And then the process started all over again. They started building. But long story is that when you get into any investment or if you get into any asset class, if you have a short-term 6-month view of the market that you're in, there's a good chance you can get spanked if you don't get your timing right.
Absolutely.
But if you expand your horizon, which is what you're saying, to a more realistic period of time, then you're going to look at the big picture better, and you're going to realize the ebbs and flows, how things are, and you're going to realize that the underlying realities of Miami is that it's not a big city. There is a lot of demand. There's a lot of growth. It is legitimizing itself as a hub, and look at our other articles with the amount of hedge funds that are moved in and other banks and other businesses that are actually legitimately stapled here for what seems to feel like a permanent position. It's going to move our markets forward. It's going to grow our markets. It's going to grow the values of properties over time. We're going to have a little bit of movement, but don't try and time it within 2 or 3 months. Just, as we always say, just pick up the phone, have a conversation with us. Absolutely. This is what we do. And each individual needs to look at their individual situation with their house, their condo they're buying, and weigh it up and understand the risks and the variables involved. Yeah. So I always say that within our industry, we could write books about the lunacy and the craziness that goes on. And everyone jokes about South Florida as being a kind of a, it's had its wild moments, let's put it like that. So with that in mind, and in that vein of thinking, I want you to share one of your crazy stories with me, because everyone's got a crazy story. And I know you've got a crazy story.
I have more stories than you could. Well, you probably have crazy stuff too. Man, there's so many things that come to mind. I could give you about 5 right now. Give me one. Give me one. Right, so last week, we're leading up for the holiday. I've got a client. His 3-day TRID CD goes out. So essentially, it's the CD that goes out to basically start the 3-day clock for closing. This guy's closing scheduled for Friday. The title company's on board. The closer's already balancing docs. Everything's good. This guy, I get a call from the underwriter. Hey, we just did our credit report and our verification of employment for your client. Verification of employment came back great. Were you aware that he bought a Lamborghini Urus yesterday?
What a dipshit.
2 days before closing. So I called this guy and I'm like, his debt to income ratio is destroyed. $3,800 a month was his payment. And I call this guy and I'm like, hey, I have a question for you. What was going through your mind when you walked into the Lamborghini dealership and you bought a Urus? And he was like, oh, yeah, dude, this thing is sick. I'm happy to pick you up after closing. We'll take it for a ride. I'm like, there is no closing. You don't qualify for this loan anymore. You bought a Urus 2 days before closing. And he was like, that's it. Look, no, you got to explain to the underwriter something. He was like, I'm renting this thing out on Turo and I'm making a ton of money off of it. Like, this is his whole business model. He came up with this idea that
the luxury car rental. So I've heard about this.
So he's like, I'm going to buy the Urus. It's $3,800 a month, but I'm going to rent it for like several $100s a day on Turo. And so the concept makes sense, but dude, you did it 2 days before your closing. And he thought by signing the 3-day TRID CD, he was closed, but the closing was set for Friday. So we have to go through now. The whole loan's being restructured. I had to get an extension. The sellers want like an extra $100,000 in the earnest money deposit to like give him another extension. And it's crazy. Like, it's just lunacy.
How old was this guy?
He was in his late 20s.
Really? Okay, so I think that these kind of stories, and I think these are good lessons for those people out there. Well, firstly, don't go out there and buy a Lamborghini Urus or any kind of supercar.
Until after you have closed and funded.
Common sense. But what happens is that we've seen so many of these professionals. I'm going to call them professionals. It's kind of a polite word, but I think that's a very loose term. These individuals come in and they want to lead the lifestyle.
Oh yeah,
and
for sure.
And there's a Warren Buffett saying, "You don't know who's swimming naked till the tide goes out." There's a lot of psychology that is very similar to the psychology in 2008, which is, if I do this, I make money. If I do that, I make money, and it's okay. And I'm gonna fly as close to the sun as I possibly can get,
exactly,
without melting my wings. It's Drew, love that story.
Oh, yeah. And I've got another one. Okay. This one just happened last week. Also, I've got a closing. This loan was scheduled to close on Thursday. Was it Thursday? It was also last Friday. It was scheduled to close. It was a new construction development for an Airbnb buyer. He buys a lot of Airbnbs. This he knows what he's doing. So he goes under a new development. It was $2.8 million. Not a big deal. When they do the initial appraisal, obviously the place is still under construction. So before closing, we need to do a final inspection. It's called a 1004D. And so tell me why the appraiser goes out to do, this is the final condition we need to close. I've got title, I've got insurance, I've got all the conditions from the client. Everything is submitted. All I need to clear to close this file is a 1004D final inspection. I get a call from the appraisal management company and the underwriter telling me the appraiser just went out to the property. It's still under construction. And I said, what do you mean it's under construction? I got the certificate of occupancy 2 weeks ago. I said, this is impossible. Sure enough, I called a client to ask what's going on. This guy hasn't even closed on this property yet. He sent a general contractor out to the property to blow out the wall and build 3 extra rooms because he's going to shoot up his profits on Airbnb. And I'm like, why would you not wait until after you close?
He hasn't closed on it, and he's already demoing.
Demoed the place, added 3 extra rooms to the property. Like, I understand it from a long-term profitable standpoint, but he doesn't own this property. It's insanity. So, we had to do this whole workaround. Thank God the appraiser went out, and he didn't somehow, by God's grace, this guy didn't realize there was 3 extra bedrooms in the house. He just saw that it was cleaned up and it was good, and he just checked the box, and we got the deal done a week late, but we still got it done. But that could have easily gone the other way. And this guy had almost $500,000 in earnest money deposit that could have been at stake.
Wow. Wow. That's all I can say. Wow. Drew, thank you for doing this. Really appreciate it.
I appreciate you having me on.
Anytime. We'll bring you back in.
Thank you.
And as always, follow us, see our information below, see Drew's information below, and stay tuned for another David Siddons group podcast video that we will come up with a name for. Thanks again for watching. Cheers.
Thank you.